The Prudential Regulation Authority, part of the Bank of England, is set to introduce stringent new rules on buy-to-let borrowing credit (YUIMOCPA). Stringent new rules for mortgage lending to buy-to-let investors with multiple properties could mean that some can no longer borrow to fund a business, Telegraph Money research has found. Buy-to-let investors with 4 or more properties will find it harder to raise finance from the end of this month when tough lending regulations are introduced by the Prudential Regulation Authority, part of the Bank of England. Landlords who seek finance after October 1st will have their entire property portfolio assessed for viability, as opposed to just the individual property concerned, as is currently the case. Brokers surveyed by this newspaper said the changes would mean, at best, a huge increase in the amount of work landlords will have to do when they apply for a mortgage and, at worst, some landlords struggling or failing to get a loan at all. The market could also shrink as banks abandon this part of the market entirely. This would be likely to lead to higher fees and interest rates. The Prudential Regulation Authority, a part of the Bank of England whose Governor Mark Carney is pictured, is set to deliver another blow to landlords' credit. Andy Rainey, one of Britain's biggest lenders, Santander, has already told mortgage advisors that it will cease lending to landlords with large portfolios who want to increase the borrowings. It will continue to lend for the purposes of pound-for-pound remortgaging, but even then only with tighter rules around purchase date and income. Sean Church of Private Finance, a broker, said already we are seeing the mainstream lenders taking very different approaches to how they will work with these borrowers. Some are saying that if you have 4 or more properties, we aren't going to lend to you at all, probably because they don't have the resources to deal with the extra workload. In the middle, some are saying we will lend, but it's going to become much more complex. Then some of the more specialist lenders are more or less enforcing the rules already, so there won't be much change. Ray Bolger of John Charcoal, another broker, said some smaller lenders such as Platform Home Loans had announced that they would no longer be carrying out this sort of work, while other specialist lenders would be largely unaffected. The new rules will apply only to individual landlords, not to those who own the portfolio through a limited company. Who will be the winners and losers? The rules are likely to place significant barriers in the way of many landlords, particularly those with larger portfolios. How can you really expect to check someone with 100 properties or more? Mr. Church said. It will become exponentially more difficult for them to get finance. Experts warned that, in addition to the extra work involved, a fall in the number of lenders prepared to operate in this market would lead to increased costs for borrowers. Whenever there is less choice and competition, we always see an increase in cost, Mr. Church said. It's fair to say the cost of borrowing for portfolio landlords is likely to increase. If your lender had a rate that was market-leading, you could well see that change. Mr. Bolger said there will be a reduction in the number of lenders prepared to do this. Those that do still offer mortgages will be required to jump through a lot more hoops, and borrowers will have to provide more information. The PRA lending squeeze is the latest in a string of hammer blows for buy-to-let investors' credit. Simon Dawson, Bloomberg Finance LP. And the nightmare scenario for landlords is finding themselves unable to remortgage. This could lead many to become mortgage prisoners, locked on their lender's variable rate, which is usually much higher than the alternatives. Mr. Bolger said it was inevitable that some landlords would fall into this category, albeit a relatively small number. The people most at risk will be those in parts of the country where property values have done badly, he added. In London and the southeast, the chances are you will have seen quite a big gain, but in parts of the north and Northern Ireland, prices have remained very low. This won't help, but some banks could, if they master the new rules quickly, steal a march on the rivals. Mr. Church said, I think the winners are going to be the new challenger banks. They will be coming in fleet of foot and will be able to make changes more quickly than the big banks. The likes of Halifax making changes can be more like turning an oil tanker. What can borrowers do as limited companies are unaffected by both these regulatory changes and the separate tightening of tax relief? It will be tempting for new landlords to choose this structure. Borrowing as a limited company will mean you pay higher mortgage rates and have the other administrative costs involved in running a company, but is likely to be cheaper in the long term. However, it would be very expensive for established landlords to transfer their portfolio to a company, as it would create stamp duty and capital gains tax liabilities. Instead, those investors should consider applying for any loans they need straight away. Mr. Bulger said if you're looking to remortgage at the moment, get in quickly because some lenders are still working to the old rules. There will be less choice in a few weeks when the new rules come into force. One of the interesting questions is whether lenders will take a global view, he said. Will they want every property in a borrower's portfolio to be viable, or if one or two are not making money but the portfolio is viable overall, will that be acceptable? He added that more stringent requirements on personal income were likely to make a big difference to landlords at the margins, and drastically reduce the level of choice. About buy-to-let tax changes. The buy-to-let market has had a tough few years. First, in April last year, the 3 percentage point stamp duty surcharge on second purchases created an extra cost to expanding your portfolio, and then the changes to income tax relief began to bite earlier this year. By 2020, landlords will be unable to offset mortgage interest from the taxable profits, meaning a higher tax bill for most. Basic rate taxpayers will receive a 20% tax credit, so the change will primarily affect higher earners. Lenders have also been forced to stress test the loans at a hypothetical interest rate of 5.5%, despite mortgage rates generally being at an all-time low. But the latest changes to portfolio landlords could be the worst blow of all. Mr. Church said, "I don't think people have really realized how far-reaching the impact on the market will be. We've had the tax changes and we've had plenty to deter the amateur landlord with the stamp duty surcharge, but actually this is the one that will affect the rest of the market and the big boys." Listen now, it's your money podcast.